the best of Money Matters. Market View on Money FM 89.3.
You're listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for today, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. The SCI closed up at 0.1% at 4,276 points. A slew of fresh data out of Asia highlighted both resilience and fragility across the region. In China, new home sales by the top 100 developers plunged 17.6% year-on-year in August, following a 24% slump in July, marking its sixth straight monthly decline. At the same time, the private manufacturing PMI surprised to the upside at 50.5, its fastest pace in 5 months. Moving over to South Korea, its factory activity stayed weak with its PMI at 48.3 in August, the 7th consecutive month below 50. New exports fell for a fifth month as U.S. tariffs of 15% on Korean imports came into effect. Meanwhile, in Japan, the manufacturing PMI came in at 49.7, still in contraction, but an improvement from July's 48.9. Yet new export orders dropped at the sharpest pace in nearly 18 months, even as firms added staff for the 9th month in a row. Now, for more market moves and views, joining us today is Willie Keng, founder of the Dividend Titan. Hi, Willie. Happy Monday.
Hey, good evening, Alex. Thanks for having me on the show.
Thank you for joining me. Okay, Willie, the SCI opened at 4,270 points. What do you think drove market sentiment this morning? Any major movements being led by specific sectors?
Yeah, I mean, if you look at how markets have actually moved this morning, I think it's generally on a more optimistic side. We see the STI closed slightly higher at the start of the week. I think this is really driven by a couple of cyclical sectors. I think number one is Yangtze Shipbuilding. I think shares have actually rose about 6.5% for the day itself, and really on the back of very strong positive news because Yangtze Shipbuilding has recently announced it has secured additional shipbuilding contracts for its 22 vessels. That's worth roughly about 1.1 billion Singapore dollars, and that has pushed up its order book to close to about $16 billion year to date. So that's actually quite impressive coming from the shipbuilder itself. And I think what's interesting as well is because this being a cyclical sector, I think right now for Yangtze we have actually been sort of on an upward trend or upward momentum, especially when freight rates are actually on the positive side. So you have container ships, you have dry bulk vessels, they all have actually increased their volume across not just in the intra-Asia route, but also the global route as well. So that's sort of a positive news for Yangtze. Also, if you're looking at the three local banks, I think that has also sort of came in a mixed bag. We have DBS down about 0.5%. Meanwhile, you have OCBC and UOB up. I think really on the back of, news on China, where some of these banks, our local banks, still have loan exposure to the world's second largest economy. However, having said that, DBS, for instance, still trades at close to its all-time high and really on the back of very, very strong results. I mean, earlier in August, we saw how DBS, for instance, having healthy results where their pre-tax profits have hit a record of close to $7 billion. Its return on equity still stands at about 17%, and asset quality still remain resilient. So I think that has actually bode well for the three local banks, and that has sort of driven the momentum for the STI index. And of course, you also have other stocks as well, which I want to put particular focus, which is the property sector. So you have Guaco Land, which came in, and that actually reported they have recently announced that they have decided to sell one of its Johor Bahru hotel for about 46 million Singapore dollars. So this combined property has roughly a net book value of 93 million ringgit, roughly about a land area measured at about 24,000 square meters. So far, Guaco Land has actually enjoyed some gains, particularly on its balance sheet. And then also in moving on to Oxley Holdings, the property developer also sort of posted narrow losses for its latest second half year financial results compared with its $94 million profits in a year ago. So this small to mid-cap developers' revenue actually rose about 60%, close to about $200 million, was up about $124 million. So the counter actually closed slightly lower, and also because of its exposure to the China's property sector, so that it sort of remained under pressure for some of its new home sales. I think what's crucial to watch is that Oxley has sort of diversified itself away from Singapore and across, not just regionally, but also globally in terms of its property development. So these are some of the few key drivers. I think overall, I think most of what's going on into this market is really driven by some of the cyclical sectors which I'm observing.
Now, still in the property sector, Willie, let's look at China. Property sector actually remains under pressure because in August, new home sales among the top 100 developers dropped 17.6% year on year after a 24% slump in July. That makes 6 consecutive months of declines, despite both Beijing and Shanghai easing some home buying rules last month. Now, analysts have called these moves incrementally positive, but far from enough to reverse the slump. Do you see this property slump as a short-term confidence, or will this keep weighing on China's economy?
Yeah, I think right now all eyes are actually on the real estate sector, especially how we have seen over the past year. We have the CSI 300 index, the Hang Seng index have really outperformed global markets. And I think ever since last year in September 2024, after the Chinese government came out with their very heavy stimulus measures, that has started to prop up the real estate sector in China. So I think there's still a lot of room for improvement and recovery, because if you look at how the housing market recovery is like in the US, it's not really a sharp rebound as it experienced back in the global financial crisis. But what happened was there was actually what you call ups and downs. There was some delayed data, and the housing recovery in the US actually took some time for it to actually see a meaningful improvement. And I think that can also be said the same for China as well. I think one thing which we are seeing, one positive sign, is we are seeing narrowing of its declines in terms of its new home sales. I think that's one positive signal which we can actually look at. Another thing which we can also observe is how the secondary home sales transaction have actually so far improved since last year. And I think that is also one forward indicator to watch how the real estate sector is unfolding itself. So I believe that if you look at how the real estate sector is definitely still a drag on its economy, given the fact that a large contribution of this sector is still accounting for a large part of China's GDP. But if you look at what the Chinese government is doing, is actually pivoting, not just pivoting away from the real estate to more domestic consumption. But if you recall, earlier last week, you have Premier Li Qiang, which came out to say that he wants to actually call on for the need for action to stop the decline in the real estate market. And I think this sort of sends a serious message to investors and to the market on what the commitment of the Chinese government with regards to the property sector itself.
At the same time, China's manufacturing actually showed some surprising resilience. The private sector PMI rose to 50.5 in August, its fastest pace in 5 months. And while the official PMI still showed contraction for the 5th straight month, can we take this as a sign of genuine recovery in the sector? And are there specific sectors you think will deliver sustainable growth?
Yeah, I think this is a very good point here. So if what we are actually seeing now in the economic data, we are seeing some slight improvement in China's manufacturing data, especially coming from the manufacturing sector. I think this is one thing which is worth looking out for, is what you call the China involution, where you have actually intense competition coming into the market. So this sort of shows some vibrancy in the domestic economy and in domestic consumption itself. And as a result, I think we are also seeing a lot more competition. Companies, manufacturers, I think they are also ramping up their production capacity, their volume as well, in order to meet the potential demands coming not just from the domestic market, but also from the global market as well. So if you look at recent financial results coming from China's mega banks, so if you're talking about ICBC, CCB, ABC, and Bank of China itself, I think some of the profit margins have sort of been eroded. But if you look deeper into the detail, what is actually happening is that a lot of some of their finances from these Chinese banks, they are coming under strain is because of sort of their social duty to help lift the economy, to expand lending and loan subsidies as well. So this is sort of a reflection that we are actually seeing some form of recovery in the sector itself, although this might sort of take some time to unfold itself.
Now, moving to South Korea, its manufacturing PMI stayed in contraction for the 7th straight month at 48.3 in August, reflecting a weak global demand and higher U.S. tariffs. Output fell for the 6th month in a row, while new export orders declined for the 5th month, marking the steepest drop since April. How much of South Korea's weakness do you think comes from short-term tariff pressure versus deeper issues in its export-driven growth model? And could soft domestic demand soon become a large concern as external trade shocks Korea's economy?
Yeah, I mean, if you look at earlier this year, you have the tariff war, which have impacted not just global economies, but also in Asia itself. And definitely South Korea has taken a hit, largely because its GDP is also driven by its export sector. So definitely tariffs have actually impacted some of the business conditions and also the firms which actually have a large portion of their business going into the global markets. So if you look at the most recent data, we are also looking at sharp decrease in the incoming business inflows. New orders have actually fell for the 5th month, running midway through the 3rd quarter of this year. And also, you have some of the local firms citing a subdued domestic economy and also the impact of U.S. tariffs, like what you have mentioned, as the key factor behind the fall. So there's actually some temporary setback because of the trade war, which actually happened earlier, and that have sort of trickled down to some of the firms in South Korea.
Now, still in Asia, Japan's manufacturing PMI was at 49.7 in August, which is still below the 50 mark, though an improvement from July's 48.9. The improvement was driven by a slower pace of output decline, but new export orders fell at the sharpest pace in nearly 18 months, as demand from China, Europe, and the U.S. weakened further. How vulnerable is Japan's export-reliant economy to a global trade downturn, especially given its dependence on autos and machinery?
Yeah, I mean, if you look at Japan's export contribution, it's roughly about 15 to 20% of its entire economy. So even though it's a smaller proportion of its GDP growth, but it weighs on a significant impact on its economy as well. So it's not a big figure, but significant enough to actually put some thought into it. You can see how Japanese firms, what's interesting is that they do have some impact from this export-reliant economy. However, if you see what Japanese firms have actually been doing, they have actually been increasing their staff over the last 9 months. So despite some of its potential global trade downturn, which could impact its export economy, but this adding or this increase in their staff or in their team across the different companies has sort of suggest some optimism about the future demand and also preparing for labor shortages in Japan itself. So I think there's actually some bright spot amidst this vulnerability in its export-reliant economy.
Well, thank you so much for today, Willie.
Yep. Thank you so much, Alex.
That was Willie Keng, founder of the Dividend Titan. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.